At its peak, the cryptocurrency exchange FTX reached a valuation of $30 billion. The foundation of that empire was a corporate white paper, a pitch deck promising a revolutionary approach to risk management that federal prosecutors eventually used to build their criminal case. The architect of this platform was Sam Bankman-Fried. He presented himself as a quantitative expert capable of bringing institutional rigor to the crypto markets, and the industry responded by providing billions of dollars in venture capital. When read alongside the criminal indictments, the internal logic of the original pitch changes. The document provides the mechanical blueprint for the largest financial fraud in the history of the industry. The document explicitly identifies the crippling flaws of existing exchanges as its primary target. The stated mission was to solve these systemic problems and move the derivative space toward becoming institutional grade. To capture Wall Street capital, FTX needed to build a platform that appeared to have automated away systemic risk. Providing a convincing model of algorithmic safety was the prerequisite for attracting high-volume institutional traders. The center of this ecosystem was FTX's own cryptocurrency, the FTT token. The white paper introduces FTT as a utility token, offering users specific discounts on trading fees based on the size of their holdings. The document also promises a token burn mechanism. The exchange committed to using 1/3 of all generated fees to repurchase FTT from the open market and destroy it, theoretically creating continuous upward pressure on the token's price. To differentiate itself from competitors, FTX marketed a 3-tiered liquidation model. This automated system was designed to close down failing positions in stages, which would prevent the massive customer losses known as clawbacks. To a quantitative investor, these features suggested a robust risk environment. Universal stablecoin settlement, combined with an automated liquidation engine, created a closed-loop system where data dictated the outcomes. On paper, FTX had successfully modeled a platform where volatility was managed by code. The risk protocols appeared bulletproof, provided the underlying collateral behaved according to the established rules. A critical structural risk was present in the token utility section from the beginning. One specific clause allowed for the bypass of standard risk management. FTT can be used as collateral for futures positions. The document then introduces Alameda Research, framing it as an independent quantitative trading firm. The pitch describes Alameda as a largest liquidity provider and market maker for the exchange. In practice, Alameda functioned as a sister company. They used the self-issued FTT tokens to access real customer liquidity stored on the exchange. The token burn mechanism helped maintain the market price of FTT, allowing Alameda to record the tokens as high-value assets on their balance sheet. They then used this inflated collateral to borrow liquid stablecoins directly from the pool of customer deposits. The features marketed as benefits to retail users actually functioned as tools to support Alameda's institutional leverage. The price of FTT was artificially supported, so it could be used as collateral for massive, undisclosed borrowing. The SEC later alleged that the exchange's automated liquidation engine contained a hard-coded backdoor. This specific exemption allowed Alameda Research to maintain a negative balance and withdraw billions in customer funds without being liquidated. The white paper's promises of automated risk management were contradicted by the internal code. While the public text described a system that protected against losses, the actual software granted Alameda an $8 billion line of credit fueled by customer money. This arrangement created wrong-way risk. In finance, this refers to a situation where your exposure to a counterparty increases at the exact same time that counterparty's credit quality declines. Because Alameda's loans were collateralized by FTT, a drop in the token's price would trigger a margin call. To meet that call, Alameda would need to withdraw more liquidity from FTX, the very liquidity that was already being drained by the falling value of the FTT collateral. Algorithmic risk models offer zero protection when founders program a secret exemption for their own accounts, relying on circular, self-generated collateral to balance the books. The collapse began in November 2022. A report from CoinDesk revealed that Alameda's balance sheet was comprised almost entirely of illiquid FTT tokens, exposing the circular nature of the firm's capital. The situation escalated when Changpeng Zhao, the CEO of rival exchange Binance, reacted to the news. Zhao announced that Binance would liquidate its entire position in FTT. The public announcement caused the market value of the token to collapse, triggering the anticipated death spiral. This triggered a bank run. As customer withdrawal requests spiked, the gap between liquid assets and liabilities became undeniable. Alameda had already siphoned deposits, leaving the exchange unable to fulfill the requests. Binance briefly considered an acquisition, but withdrew the offer immediately after reviewing FTX's internal books and discovering the massive hole in customer funds. The white paper's claim of having among the world's most liquid order books was proven false. That liquidity depended entirely on the market's willingness to accept unbacked circular collateral. The theoretical failures of the risk model eventually led to direct legal consequences in a federal courthouse. Sam Bankman-Fried was convicted on 7 counts of fraud and conspiracy. His actions resulted in a 25-year prison sentence. Several members of his inner circle, including the CEO of Alameda Research, also pleaded guilty to criminal charges for their roles in maintaining the fraudulent accounts. The mathematics of the blockchain functioned as intended. The collapse resulted from a catastrophic failure of governance and calculated human deception. The event highlights the danger of vertically integrated exchanges. When a single entity controls both the trading venue and the primary market maker, conflicts of interest become inevitable. Investors should view corporate white papers as marketing documents rather than technical specifications. These documents can hide structural risks behind a facade of institutional jargon. Effective due diligence requires mapping the incentives of the founders and verifying the actual nature of the collateral used to support the platform. Ultimately, institutional-grade safety is secondary concern on a platform where transparency is replaced by undisclosed backdoors and circular accounting.